Most forms of technical analysis examine a single variable like a stock or exchange-traded fund, also known as an ETF. Intermarket analysis is a more complex form of technical analysis. With intermarket analysis, instead of looking at an investment on an individual basis, investors typically consider multiple related asset classes. The theory behind intermarket analysis is that assets such as currencies, commodities, bonds, and stocks are all connected. When something impacts one asset like currencies, it sets off a chain reaction that influences other asset classes. Investors who subscribe to the idea of intermarket analysis typically monitor economic indicators to anticipate potential intermarket movements. These indicators include growth rates, employment, manufacturing, inflation, interest rates, and many others. Because of all these moving parts, intermarket analysis is complex and nuanced. It requires a lot of experience to understand the relationships between various moving parts of the economy. In this way, intermarket analysis is kind of like forecasting the weather. Meteorologists use multiple variables when producing tomorrow's forecast. These might include barometric pressure, satellite images of cloud formations, wind speeds, and other atmospheric conditions. Using multiple variables gives a meteorologist a better view of the bigger picture. From this picture, a meteorologist recognizes patterns and applies them to create a more accurate forecast. Investors who use intermarket analysis use it in kind of the same way. They look for repeating patterns among assets to get a better view of the big picture. They consider the relationships between currencies, commodities, bonds, and stocks when using intermarket analysis. For instance, some may watch for changes in currencies to impact commodities. They may pay close attention to currencies of countries that export commodities. One example of such a connection is the relationship between the Canadian dollar and crude oil. Canada exports a lot of crude oil. Because of this, the Canadian dollar is sensitive to price changes in crude oil. Typically, they both move in the same direction. Another intermarket relationship some investors may watch is the relationship between commodities and bond yields. These assets are linked by inflation expectations. Investors might buy commodities and sell bonds when they expect inflation to increase. Conversely, they might sell commodities and buy bonds when they expect inflation to decrease. Another example is the relationship between stocks and Treasury bonds. Some investors view stocks as relatively risky and Treasury bonds as relatively safe. Because of these differences in risk, investors might buy stocks and sell Treasury bonds when they think the economy is going to grow. Conversely, when investors think that the economy might slow, they might sell stocks and buy Treasury bonds. As you can see, intermarket analysis can be used to identify a variety of relationships between asset classes. Investors who utilize intermarket analysis often believe that a move in one of the asset classes could precede a move in another. These connections are what investors can use when developing intermarket strategies. They'll identify a potential relationship between asset classes and then wait for one to signal a future move in another. It works like this. Suppose an investor is monitoring the Canadian dollar and crude oil and assumes that these two assets are connected. The investor might look for the Canadian dollar to indicate where crude oil might move next. Observing the move higher in the Canadian dollar, this investor might buy crude oil, expecting it to follow the currency's lead. Of course, there's no guarantee it will happen. When using intermarket analysis to develop investing strategies, investors are making an assumption that one asset typically leads while the other follows. The sequence of which one leads and which one follows often changes. For instance, when considering currencies and commodities, sometimes the commodity moves first and the currency follows second, and vice versa. The relationships among asset classes evolve over time, which makes intermarket analysis a complex and challenging strategy. Remember, past performance does not guarantee future performance. To better understand intermarket analysis, it takes experience observing the relationship between asset classes through different phases of the economic cycle.